America just crossed $38 trillion in national debt, and the world's trust in the dollar is falling faster than at any point in the last 30 years. Interest payments have grown past $1.2 trillion. Foreign governments are selling US Treasuries, and for the first time in modern history, gold and Bitcoin are rising together, a clear warning sign that a money system is breaking. Behind closed doors, the US is preparing a change so big it rewrites how the dollar works, who controls it, and how America lasts through its own debt circle. What comes next is not a guess, it is already happening. The US economy has reached a stage where debt no longer works as a tool. It has become a built-in danger that grows bigger with every passing 3 months. What makes the current crisis especially dangerous is not the size of the national debt alone, now over $38 trillion, but the speed at which the system is losing its safety layers. For many years, global trust acted as the steady part. The world trusted US debt so deeply that it accepted low returns, low-risk additions, and endless changing. That trust is no longer sure. And once it weakens, every dollar of debt becomes much more costly to keep. The numbers show how quickly steady can turn around. In just 5 years, interest payments grew from $500 billion to over $1.2 trillion, taking more than 20% of federal money. This is not just money pressure. It is a big money break. When interest duties rise faster than tax money, the government becomes trapped between raising rates to protect the dollar or keeping rates low and letting price rises take away buying power. Either choice speeds up the bad circle because both ways weaken trust in long-term treasuries. The heart of the circle is what money experts call the term addition. The extra return investors want to hold long-term US debt. Normally, it sits near 2%, but today it stays around 0%. Not normal low and dangerously weak. If global investors decide the US money place is getting worse, which the debt path clearly shows, the addition can jump back right away. A move from 0% to 2% would push the 10-year Treasury from 4% to roughly 6%, starting a chain reaction across house loans, company loans, and state money. Suddenly, the entire credit setup becomes more costly overnight. This is where trust changes from a help into a problem. The US depends on investor trust more heavily than any nation in history. Once that trust weakens, debt changing becomes a breaking force rather than a safety way. The bad circle begins when rising rates weaken trust and falling trust pushes rates even higher. It is self-making stronger, self-speeding, and impossible to stop without bringing a new way to take demand for US Treasuries. And that is exactly why the government is quietly making a money change through digital base. The only way to create a new group of debt buyers before the old ones go away. The breaking of US reserve power is not idea only. It is measurable, speeding up, and now clear in data that central banks once hoped would never come out. For more than 2 decades, the US dollar held a strong hold on global reserves, always controlling 60 to 72% of worldwide foreign money holdings. That steady created a false picture of forever, a belief that no matter how much America borrowed, the world would always want dollars. But in the last 24 months, that idea has broken. The dollar's share has slipped below 60%, marking the sharpest drop in over 30 years. And the trend line is now falling at its fastest pace since the time after the Vietnam War. What makes this drop so dangerous is its time. The dollar is losing global power exactly as US debt is growing past $38 trillion and as interest costs are rising at a size not seen in modern money. Reserve status is what once kept the US safe from the results of its own spending. It made sure foreign governments would automatically buy treasuries, holding returns low and making US debt look good. But today, the world's largest reserve holders, China, Japan, Saudi Arabia, and key growing market groups are lowering openness. China alone has cut its treasury holdings by over $300 billion in recent years, and Japan's group has shrunk as its home money pressures grow. Behind every percentage drop in dollar share is a basic truth. Global trust is no longer without conditions. Nations that once put trade extras into US bonds are now moving money into gold, goods, two-side money, and area payment systems. This change does not just lower want for the dollar. It weakens the built-in hold that kept long-term interest rates low for many years. When fewer governments hold dollars as reserves, fewer governments step in to buy treasuries when markets get tight, leaving the US more open to return jumps started by trust shocks or money getting worse. The weakening of reserve power directly makes bigger the weakness already breaking US borrowing costs. As the world changes away from the dollar, the safety space around Treasury want shrinks, pushing the system closer to a case where the US must create new outside want ways to steady its money. That pressure sets the stage for the government's next move, making other buyers through digital markets to stop a full-size trust break. The most dangerous part in America's money setup is not the debt itself. It is the quiet grower attached to that debt, the term addition. This single measure decides how much extra return investors want to hold long-term US Treasuries. And for many years, it acted as a quiet safety shielding the government from the full cost of its borrowing. But that safety is going away, and once it fully changes back, the results will be right away, strong, and not able to change back. Normally, the term addition averaged 2%, showing strong global trust in America's long-term steady. That trust allowed Washington to borrow trillions at not real low rates because investors were willing to accept less pay for holding US debt. But today, the addition sits near 0%. A not normal reading that exists only because markets still hope the US will keep good name. The problem is that hope is getting thin. And when it breaks, the term addition will not return slowly. It will jump back like a spring. A move from 0% to 2% may sound small on paper, but it would push the 10-year Treasury return from roughly 4% to 6%, right away raising the government's changing costs by hundreds of billions of dollars. House loan rates would rise, company money would get tight, and credit markets would feel the shock within days. The US is already paying more than $1.2 trillion each year in interest. An addition normal would drive that figure even higher, forcing deeper money short and speeding up the very loss of trust that started the jump. What makes the term addition so dangerous is its feel to global view. It shows not price rises, not Federal Reserve rule, but trust, especially trust in America's long-term money direction. As foreign central banks lower their treasury openness and the dollar's reserve share goes down, the markets willing to accept a near-zero addition becomes more and more not able to last. Once investors decide the risk built in US debt is underpriced, returns will change right away with no political talk and no central bank help able to change back the feeling shift. This is the hidden weakness linking America's debt circle to the drop of its global reserve status. When the term addition changes back, the system will face borrowing costs it was never made to hold, forcing the government to search for completely new sources of want for its debt. The most worrying proof that global trust in US debt is weakening comes from the two nations that once kept the treasury market steady almost alone, China and Japan. Together, they held more than $2 trillion in US Treasuries, acting as the base of foreign want for American debt for nearly 2 decades. Their change from strong buyers to steady sellers marks a built-in break in global money, one with direct results for the US interest rate system already tight by the falling reserve share and the weak term addition. Japan, long the world's largest foreign holder of treasuries, is lowering openness at a pace not seen since the early 2000s. The reason is simple but bad for US borrowing costs. Japan is fighting its own money crisis. To protect the yen, the Bank of Japan has allowed home returns to rise from near zero to levels that finally draw Japanese investors back home. Every up move in Japanese government bond returns takes money out of treasuries. In effect, America is losing a many years long help that not real kept its long-term interest rates low. China's reasons are even more important. Its treasury holdings have fallen by more than $300 billion from their high, and the drop is speeding up. But China is not just moving money. It is changing its whole world money plan. The use of the dollar as a tool through punishments, the change toward UN-based trade settlements, and the push for good-backed reserves all make US debt less attractive for Beijing. For a nation that brings in massive amounts of energy and raw materials, holding treasuries has become plan risky and money not needed. This double leave creates an empty space the US cannot easily fill. China and Japan were not normal investors. They were expected long-term steady who took treasury supply during times of stress. Their pullback lowers the ready safety that once kept returns held, making the system far more open to sudden rate jumps started by trust shocks or money getting worse. With the two largest foreign backstops stepping away, the US faces a new truth. Normal government buyers will no longer take its growing debt. And without them, Washington must find a completely different group of buyers, one able to replace nation want on a world size. That search leads directly into the growing world of digital dollars and crypto-backed treasury using. As normal foreign buyers pull back from US debt, the government is quietly growing a new group of want. One that does not depend on world friendships, trade extras, or talk goodwill. Instead, it depends on the fast rise of stablecoins, digital tokens backed by real US dollars, and more important, US Treasuries. What started as a small tool for crypto traders has grown into one of the most powerful outside engines of treasury want in the world, growing at a speed foreign central banks cannot match. The numbers show the size of the change. The combined market value of major stablecoins has risen to roughly $200 billion, doubling within just 2 years. And unlike normal money reserves, which change based on political thoughts, stablecoin giving is tied directly to market want. Every new token must be backed by safe, ready assets, mainly short-term US Treasuries with returns between 4 and 5%, making them perfect support. As a result, givers like Tether and Circle have built treasury holdings like medium-sized nations. They are no longer small players. They are among the fastest-growing holders of US government debt on the planet. What makes this growth plan valuable for Washington is that it creates made global want for treasuries at a time when official foreign buyers are stepping away. The US does not need China or Japan to buy long-term bonds. If millions of users across growing markets take digital dollars for daily deals from Latin America to sub-Saharan Africa, stablecoin use is rising at yearly rates above 30%, driven by not steady local money and not reliable banking systems. Each user indirectly increases want for US debt without ever dealing with the treasury market directly. Stablecoins work as a back doorway. They build treasury buys inside the base of the global digital economy. Unlike central banks, which can lower holdings due to political problems, stablecoin want grows natural through market forces. This is why treasury leaders think the sector reaching $2 trillion, a size large enough to rival and possibly replace the lost want from Asia's falling buyers. This growing digital base gives the US what it needs: a new engine able to take debt in a world where normal reserve setups are going away. And it sets the stage for a deeper change. One where the government no longer depends on nations but on networks to keep its money power. What appears on the outside as rule interest in crypto is in truth a plan to rebuild global want for use debt through a digital setup. The US government understands that its money power cannot last on old reserve systems alone. Not when major foreign holders are lowering openness and trust feel measures like the term edition are ready to rise. The only real path forward is to move the dollar into a setup where want grows automatic independent of world pressures. That setup is the growing digital dollar system, built around stable coins, ruled token giving, and treasury-backed digital assets. This is not a formal change set on national television. It is a built-in change built into market actions. By allowing and ruling stablecoin givers to work at large size, Washington gains access to a buyer base far wider and more able to last than normal nation holders. A digital dollar moving across millions of wallets forces ongoing treasury buys in the background, changing global money one into a lasting changing way. Treasury Secretary ideas of a $2 trillion stablecoin sector are not guessing. They show the size needed to balance falling foreign joining. The plan becomes even clearer when looking at rule trends. New setups for crypto keeping, dollar-backed token making, and payment stablecoin rule all meet toward one result: a digital dollar system built mainly on private market ways but held to US nation debt. The government no longer needs to make new dollars directly. It can give the process to stablecoin givers whose growth natural increases treasury want. This changes the dollar from a government-given asset into a mixed digital tool that grows in answer to global market need. The smart part of this way lies in its able to deny. There's no news saying a change, no big money reform. Instead, the dollar grows quietly into a double setup money. One old layer tied to normal reserves and a second layer, faster, without borders, number-backed, made to take trillions in nation debt without formal help. This is the hidden path the US has chosen. A change that avoids starting worry, uses market reasons, and builds a new base of want just as the old one begins to fall. The digital dollar plan gives the US a new source of want. But even its most hopeful ideas hit a number wall. A stable coin market worth $2 trillion may be never seen in global money. Yet it shows only a part of the weight needed to support a treasury market that has grown beyond $38 trillion. This not match is not symbol. It is built in. Digital want can balance the drop of single foreign buyers, but it cannot fight the size and speed of America's debt path. The first limit is pure size. Even if stablecoin givers put the most of their reserves to short-term treasuries, their combined holdings would cover only around 5% of the total debt weight. Meanwhile, the US is adding $1 to $1.5 trillion in new short money every year, a pace that goes beyond the growth rate of the entire digital asset sector. No matter how fast use rises in growing markets or how deeply stablecoins go into global deals, their growth cannot match the speed of the federal government's borrowing needs. The second limit is time. Stablecoin givers mostly favor treasury bills and short-term notes because ready money is needed to keep price steady. But the US needs buyers across the whole time range: 2-year, 5-year, 10-year, and 30-year bonds. The digital system cannot fill that role without breaking its own base. A market built on right-away taking back cannot support long-time debt that changes strongly with interest rates. Finally, the digital sector is built-in changing. Rule changes, market up and down, and tech weak points can shrink stablecoin supply just as quickly as they grow it. Treasury markets, by difference, need same quality. They cannot depend on a buyer base whose money shoots rise and fall with crypto-ready money cycles. This is the not able to change limit of the digital dollar change. It can slow the crisis, spread one again, and balance foreign pullback, but it cannot change back a money path that climbs into the tens of trillions. The space between a $2 trillion digital way and a $38 trillion federal duty forces the US toward a deeper end. More tools will be needed, and investors are already placing themselves for what comes next. A setting where trust moves from government debt to hard-not nation stores of value. As normal nation buyers pull back and the digital dollar way hits its built-in limit, global money begins to act in a way that shows the true level of worry inside the money system. Investors are no longer looking for return. They are looking for leave. This change is clearest in the same time rise of gold, Bitcoin, and other hard assets. A rare meeting that normally appears only when trust in government debt weakens across many regions at the same time. Gold's move alone shows the bad of the moment. Despite high interest rates, conditions that normally push down precious metals, gold has broken record highs, climbing past $2,400 and holding its speed. This is not a guessing rise. It is a money move. Central banks bought more gold in the last 2 years than in any period since the 1950s, changing away from dollar openness as reserve shares fall. Their actions show a truth they cannot say openly. Long-term trust in U.S. debt is going away, and gold remains the only political neutral protection against nation not steady. Bitcoin rise is even more showing. It is becoming a big money asset, no longer tied to small guessing cycles. Its rise during a period of tight ready money goes against past patterns, showing a change in view. Investors now see it as a protection against system value drop, especially as yearly U.S. short money go beyond $1 trillion and global need on the dollar becomes more not sure. The fact that Bitcoin rises next to gold, a meeting normally not seen, shows a wide move away from government duties and toward assets outside nation control. This move goes beyond metals and crypto. Investors are moving into energy assets, farmland, and good-backed stocks, all of which keep value during times of money thinning. These flows are not short-time. They show a planned change place for a world where the US dollar lasts, but not in the form the world has known for the last century. And when the break finally comes, it will not feel like a fall. It will feel like a change. The moment the old money time ends and a new one rises from its shadow.